And so we can see that if you invested just £50 a month over 30 years, then you would finish with the way the world is going at the moment, budgets are definitely getting tighter. Everything's just going up. Groceries, energy bills, heck, they even put the price of the PS5 up. A console that nobody's been able to buy for 2 years is now more expensive. It's crazy. It's definitely fair to say that we've got less spare cash than we used to. You might previously have been thinking about starting to invest, but with only so much money left over now, you're wondering if it's even worth starting? Well, I'm here to run through the numbers with you and answer that question. Now, we're going to be looking at a few differing amounts of money each month and also differing timelines, and this I think will give you the best idea of what you might want to do going forward. I've picked £50 a month, £100 a month, and finally £500 a month, and I hope that this will give a good range. I know that the top one is fairly high and unrealistic, but in the interest of data, I just thought it would be worth including to see what the difference is. In terms of timescales, I've gone for 10 years, 20 years, and 30 years invested. I'd never recommend investing money that you needed within the next 5 to 10 years because there's always a risk involved with investing. But with these different timescales, we can get a good idea of the different rewards of investing for longer time periods. And finally, what are we going to be invested in? Well, we're going to be investing in index funds. Index funds are really the gold standard of set and forget investing. They track the market in various different ways, but the general idea behind them is that as the world gets bigger, the market will also get bigger, and so your investments will rise alongside them. Now, I've picked the S&P 500 because everybody uses this as sort of a standard for how the world is going. The S&P 500 consists of America's top 500 companies. It includes juggernauts like Apple, Microsoft, Google, Amazon, all those big ones that you can think of. And it's considered one of the best index funds to follow, really, because the American industrial machine doesn't really stop, it just keeps on growing. And the good thing with an index fund is that if one of the companies flatlines and it falls off and it just has no value at all, then what happens is it will be replaced by the one that was next in line, the 501st. And so this way, while there is some risk in investing with everything, you're kind of going for a safer option here. You don't have to worry about picking individual companies and hoping that they outperform. Now, if you do want to know more about different types of investments, then let me know down in the comments. I can make a whole video on it, but for now, we're going to keep going with the S&P 500. Right, so no more waffling. Let's get right into the numbers. The first thing we need to do in order to calculate if it's worth investing is we need to build a model that's going to help us estimate roughly what our investment lump sum will be at the end of the time period. Luckily, we can do this using a compound interest calculator. Now, there's loads of these all over the internet, so if you don't like mine, you can always grab a different one and you can follow along with me. I'm using the Hargreaves Lansdale one just because I like how it's laid out, but there's plenty available out there, so feel free to pick your own. The second thing that we need is we need to estimate the average annual return of our investment. Now, please bear in mind this is an estimate. It's not guaranteed, but it's what we'll use for the calculation when we go through the model. For the S&P 500, then past performance shows that over the last 20 years, it's returned on annual about 9%. It's 9.87% if we're being really precise. Now, in the interest of playing it a little safer, I'm going to use 8% in our model. And this is just because those 9.8% returns are not guaranteed, and when it comes to money, personally, I would rather play it safe, underestimate, and then have a nice surprise at the end, rather than overestimate and be disappointed at the end of 10, 20 or 30 years. So we can now enter the first set of data. We're going to put in £50 a month, 10 years of growth time and an 8% growth rate. And you can see that the small contribution has added up to £9,064. That's not bad really, is it? And you can see, if we break it down, you can see that 6,000 of that is your £50 a month, and then the remaining £3,064 is the compound interest that has built up over time. That's a pretty nice return on investment overall, but as I promised, we'll now go on to some larger amounts investing so you can see the difference. Moving on to £100 a month then, your contributions rise to £12,000 over 10 years. That's probably not a surprise. The investment growth also increases, and you're now making £6,128 returns over 10 years. So your total pot is now £18,128. So you can see that's a big difference now, just from going from 50 to 100. So, maybe that doesn't stretch you too much. You can see that there's quite a big benefit of doing that. Finally, for £500 a month, I think you can probably see where this is going. A final sum of £90,641, and around 30,000 of this is from investment growth rather than your own contributions. So as you can see, it could definitely be sensible to invest even small amounts for 10 years. And, if you've got a little bit of cash lying around, you might be thinking, right, job's done, I'm off, I'm going to go make some money now. But just wait, there is a catch. And what that catch is, actually, we're experiencing right now in 2022. Now, I'm recording this on the 14th of October, and as you can see from this graph, the S&P 500 has currently dropped 25% year to date, which is staggering. It's one of the biggest drops in history, and it has taken people's investments down with it. Imagine being in year 9 of your 10-year investment plan, and this happens right now. A 25% decrease in your portfolio would take those gains that you've been so careful to build up over the last 9 years, and it would just crash them down. It's enough, honestly, to make plenty of people sell out and never want to look at the markets again, never ever. And some people will even sell at a loss. And you might think that's crazy, but just imagine the fear that you must feel when you've built up your portfolio and you can just see it dropping day in, day out for 10 months now. And the problem is that we don't know when this will end. We're not sure yet when these markets will reverse and start to go back the other way. And this is the major catch of investing. There's always some kind of inherent risk when you're investing in the markets. Now, maybe at this point you've changed your tune and you're thinking, well, you just told me that the S&P 500 annually returns 9.87%, so where's this drop coming from? And you're right. I did say that, but just look at this graph showing the annual returns of the S&P 500 broken down each year. Since its inception, the S&P 500 has grown, that's for definite, but it's not done that evenly. It's not done it predictably. You can see from the graph there are years where you've got really high gains and years where you've got really, really big drops. And then you've got years, most years is somewhere in the middle of those. And this is the exact reason why I previously said that I wouldn't recommend anybody invested money that they needed somewhere over the next 5 to 10 years. Over the long term, we can feel fairly confident that investments like this will rise, index funds generally rise, but year to year it's impossible to say which way they'll go. And this is why, as well as the 10-year, I'm also including the 20 and 30-year model, because not only does this give you more time for compound interest to kick in and for your investments to rise, but it also gives you much more time to even out those peaks and troughs. You can even them out much better with a longer time period. We did ask for 8% returns year over year after all. So we're going back to the numbers and the graphs. Does anybody else love numbers and graphs? Do they make you feel safe? No? Is that just me? Okay, all right, I'm being weird, we'll move on. So we'll change the calculator now to 20 years invested. And you can see that for £50 monthly contributions at 8% returns, your pot now rises to nearly £30,000, and 16,500 of that is based on the compound interest alone. And that's just over a 5 times increase in investment growth by adding 10 years if you compare it to the 10-year plan. £100 a month over 20 years, well, that gives you a lump sum of 57,000. And of that, 33,000 is investment growth again. And finally, just for comparison, we'll chuck in £500 a month, and you can see that you're nearly at the £300,000 mark now. And finally, the last time frame, 30 years. And so we can see that if you invested just £50 a month over 30 years, then you would finish with £70,880, whilst contributing just £18,000 of your own money. And I think this really hammers home the point that if you've got time on your side, then compound interest is really the biggest driving factor when it comes to investing. You've not actually put in that much over 30 years compared to what it has grown to. And if you do have, 20, 30 years ahead of you, then really the best time to start investing was yesterday, but it's the second best is today. £100 a month gives you £141,000, and £500 a month over 30 years gives you £708,000 at the end. I know that £500 a month isn't reasonable for most people, but I just want to show you what an incredible amount of money you can have at the end of it if you're dedicated enough to stick with a much higher amount saved and invested each month. So really, I think we've answered the question. Yes, it is definitely worth it to invest even small amounts of money into something like an index fund like the S&P 500 over 10 years plus, and the longer that you can do it, the better off you'll be. The only thing to keep in mind is that our calculations don't include inflation. They just show the flat amount of currency that you'll have at the end of the 10, 20 or 30 years. It doesn't really take into account how much buying power that money will have. If you want to include this and you want to sort of get an idea of what kind of buying power you'll have, then typically it's generally agreed that instead of using 8 or 9% for your compound interest, you instead use 6.86%. So if you want to run those calculations and those graphs back yourself using that number, then feel free. Now, there's one final piece of information that I want to share with you, and I do think it's really key. You might remember earlier in the video I showed you the graph of the S&P 500 and its returns each year, and you could see how it went. Some years it was really high, some years it was really low, most of the time it was in between. Well, I said that the longer you stay in the market, the more likely you are to take those peaks and troughs and average them out into some kind of gains along the way. And that is true. Another thing that's interesting to look at though is how likely you are to guarantee returns over a number of years worth invested. So, if you invest for just 1 year, you can make anything from minus 37% to 53.2% returns. And you just take these are the two most extremes that we've had in years after the S&P 500. So you can see that investing for like even 1 whole year in the S&P 500 it can be really risky. Change that to 5 years and those potential annual returns change. The range squeezes in. Now you go from minus 11.7% to positive 28.5%. So that range has gotten narrower. If we keep going and we change it to 10 years invested, then the range goes from minus 4.1 to 17.6%. You can see now we're really close to that negative number is not very high anymore. We're getting closer. The real tipping point though comes at 20 years invested. If you can stay invested in the S&P 500 for 20 years, then past performance shows that your annual returns can range from 0.5% to 13.2%. I hate to use the word guarantee because nothing is certain, especially investing, and a famous line is that you can't use past performance to figure out what you'll do in the future. But essentially what the data shows is that if you do stay invested in the S&P 500 for 20 years, you will make money. You've just got to be able to ride out the bad years like this one with a 25% decrease in the market. Sensible investors in index funds like the S&P 500 who regularly pay in month in, month out and are going to stick with it for a really long period of time, well, they are going to be fine. But what do you think? Are you just starting out on your investment journey, or are you looking to change things up a little bit? If you've already started investing, which strategy are you taking and how's it going for you at the moment? Comment down below and maybe we can get some discussions going. You might be interested to know the difference between investing and paying off extra on your mortgage every month, and if you are, then you can click here to find out some more information on that. Thanks for watching though. I really hope you found this one useful. I know that for me, seeing the numbers and graphs on the screen, it does really make me feel better about these things, and I hope it helped you too. Please like and subscribe, that helps me out and it lets me know that you want to see more videos like this. Thank you very much for watching, and I will see you in the next one.